Good morning and welcome to the Killik and UK market update. This week some data has been published by the Society for Motor Manufacturers and Traders, otherwise known as the SMMT, and it looks at new car sales in the UK for this year to date. The headline number is that this July has been the worst July that we've had for this millennium to date, and there are quite a few different reasons for this. One is that lots of people are still working from home and they don't need new cars to drive to work. Lots of people are being hit by this pingdemic, which means they're having to self-isolate and they can't go out shopping for cars. And we've also got this global semiconductor shortage, which is causing some problems with the production of new vehicles. However, if we look at this data in a bit more detail, we can see a clear shift away from diesel and petrol vehicles towards hybrid and battery electric vehicles. So on the top row of this chart, we've got the market share for different types of vehicle for January to July 2020, and then in the lower row we've got the same data for 2021. So what you can see is a big drop off in the market share for diesel and petrol, shown by the pink and purple blocks there, and then we've got a big increase for hybrid and battery electric vehicles. So this is really quite a significant change over the course of just 1 year, and it should be good news for companies like Volkswagen, which have been focusing very heavily on the development of new battery electric vehicles. A bid was announced for Meggitt last weekend by a rival company over in the US. Meggitt is a FTSE 250 company focusing on the defence and aerospace industries, and as you can see by the share price chart, the company has had a very difficult year, largely due to the slowdown in air traffic that's happened because of COVID. So with the share price at such a depressed level, the company has been left open to a bid. A number of people in the investment community have expressed unhappiness with this bid for a couple of different reasons. Firstly, because Meggitt is exposed to defence, the company is arguably an important part of UK national security, and for this reason, is it a good idea for the company to be taken over by a foreign rival? Fund managers who own Meggitt shares are likely to be more concerned with their own performance rather than UK national security, so they're likely to vote in favour of the bid because it will make their numbers look good. The other reason is the sheer volume of UK companies that are currently being targeted by overseas bidders. For example, we talked about the Morrison's bid just last month. At the moment, if we look at the S&P 500 index over in the US, the price to earnings ratio on average is just over 27 times, whereas if we look at the FTSE 100, the average price to earnings ratio is just under 19 times. So there's a big difference in valuation here based on this metric. For this reason, it's possible to argue that UK companies are relatively cheap, and therefore these bid attempts are likely to continue. And finally this week, the Bank of England has decided to leave interest rates on hold for the time being, but it also said it expects inflation to rise to 4%. Here's a chart that we took from the Bank of England's latest report, and it shows actual inflation over the last few years, and then the bank's forecast future inflation shown by those pink dots. So you can see the bank expects inflation to rise to over 4% before tailing back down. And in fact, it expects inflation to be above its 2% target level until at least 2023. So what this shows is that anyone who's got cash in the bank earning interest of about 0.1% at the moment is going to be losing a lot of money in real terms if inflation does rise to 4%. Moving on to have a look at next week, we've got results out from Prudential, Walt Disney and Orsted. That's it from us. Enjoy the weekend and we'll see you next Friday.